So I think we're 1 hour behind, so let's just quickly move on. Sorry, let me just quickly start the sessions. My name is Tamon from IMF, International Monetary Fund. I'm actually it's an honor to chair a session on which is sovereign debt restructuring from a economic point of view. So just before turning to my speakers, given the time constraint, we'd like to just hurry up. I just provide the broad overview. In order to, so I think the initial intent of the session was to sort of give us thoughts on what academic research has done in terms of sovereign debt restructuring. So I was kind of really asked to chair sessions. Then my intention was to cover from one perspective from theoretical analysis, which is exactly Juan and also Chatterjee is going to kind of provide the insights on it. On the other part is when we try to think about more of empirical / policy consideration, which is Aitor and Tiago have kindly agreed to provide us thoughts on it. So let me just brief sense, which is not familiar with these literatures. I think the first part of the theoretical literature is more focused on sovereign debt restructuring, how the mechanism of debt restructuring. So there's two types of debt restructuring taking place in memory. One is going to be the face value reductions, where you get the nominal value has reduced. The other one is actually the face value remains the same, but the maturity has been extended. So there's an impact on debt service. Both of them have an implication in terms of net, sort of a net present NPV haircut, net present value haircut. But I think that Juan's papers and also Chinese discussion more focus on the latter, which more focus on the maturity extension of the bonds, which is nothing less on the face value reduction. Okay. The second part, which is actually Aitor and Tiago is going to do, is actually more looking at the official financing, what's the term, and what's the sort of length of official financing likely to be, and how is going to affect in the debt sustainability / the market access. To get some sense, when you think of official financing, the IMF, which is sort of responsible, the fund financing only lasts for 3 years, which is corresponds to the program period. But the work which is Aitor's and also what the European Stability Mechanism has done is try to think what's the optimal length of the optimal financing likely to be. So that's the discussions, and also he has an exercise done with some European country cases like Cyprus, Greece, as well as Portugal, I think I remember correctly. And also Tiago is actually from Portugal. He has more insights. He's originally from the Central Bank of Portugal, so he may have insights on it. So for remark from my end is end, so I will just turn it to my floor for the speakers. Let me just introduce the speakers quickly. To my left is going to be Juan Sanchez, who is from Federal Reserve Bank of St. Louis. He has a prominent research background. He has done consumer policy issues. And on the next is going to be, as you have seen, Aitor Erce from European Stability Mechanism. And on his left, we have Satyajit Chatterjee from the Federal Reserve Bank of Philadelphia. The last speaker which we have is going to be Tiago from ITAM. Sorry, let me pronounce it. Instituto Tecnológico Autónomo. Sorry, sorry, I'm not a Spanish speaker, so that's I think that's really well. But sorry, Tiago is from ITAM, Mexico. Okay, so let's just send it forward to Juan.
Okay, thank you.
Sorry, one remark. Sorry, we accept the question at the end. So we have 20 minutes for speakers and 10 minutes for discussion.
Okay, thank you very much for the invitation. I'm learning a lot about this. So what I will present is this paper about sovereign debt restructuring, and these are my views and not the views of the Federal Reserve, of course. Okay, so the motivation is something that we document, but I think people studying sovereign debt restructuring already know is that the fact that they usually involve maturity extensions. Okay, and although these maturity extensions are very common, it's not easy, or there is no theory yet that help us think about why these maturity extensions are useful. So what we are going to do in the paper is precisely try to build a model of sovereign debt restructurings that help us understand the reason for maturity extensions. Okay, so that's the goal of the paper. So what I'm going to do is show you some evidence on maturity extensions in distress restructurings. And that's kind of the fact that distress restructuring is like one difference between some of the restructuring that you discussed before and the restructurings I will be looking at here. I will show you briefly what the model is about and show you the statistic that the model can reproduce, and then I will emphasize these 4 features that are important for maturity extension. One is the fact that the income recover between the time of default and the time of restructuring. And the second is what we were discussing in the previous paper, is the exclusion that countries have even after restructuring. It was mentioned 5.8 years in the previous presentation. I would have something similar, show you a figure. And then other thing that was mentioned that I was happy that these things were mentioned, because these are things that we incorporate, is a regulatory cost of book value haircut. So this is the cost that the banks face at the time of restructuring, so how that affects restructuring. And the last factor that is present in these models of maturity is the dilution, the fact that when for long-term debt, issuance, or new issuance of debt decrease the value of previous debt, and so that's usually an issue that is incorporated in this model, and this is going to play an important role for moving maturity extensions in the other direction, for reducing maturity extensions. Okay, so let me show you briefly some empirical evidence that we constructed using the data in Cruces and Treves and some formulas to be able to back up maturity. So if we look at this episode, 162 episodes, the haircut, depending the way you measure, but they're around 40%. But the face value haircut, the reduction in the payments, if we do not discount the payments, is around 20%. So it means that part of the haircut comes from extending the maturity of the payment. So using some formula that we have in the paper, we recover a number for the maturity extension that on average is 3.4 years. Okay, although there is like a large dispersions in maturity extensions. So if the first issue that I mentioned was that income recovers between the time of default and the time of restructuring. So this table is showing for the cases for which we found data with 149 cases, how much the GDP cycle and the GDP per capita recover between the time of default and the time of restructuring. So you can see that as some of these episodes, the restructuring is relatively close to the time of default, so there was no time for income to recover. So in those cases, you expect a very small recovery, but as you condition on the ones that took longer until restructuring, you can see that the recovery start getting larger, and you see recoveries, depending if you look at the mean or the median, of the order between 4 and 6%, okay? So the income does recover during this time. The second thing is going back to the issue of exclusion. This is from a paper of Cruces and Treves in the AAG in 2013. So what we did, they just estimate the probability of remaining excluded of credit market, and I think the issues that have been raised before are important. Is that, I mean, one criticism on this estimation is do the countries want to issue debt, or are they just, so what we observe is they issue debt or not. But what we want to show you here is that it's very high, the probability that they remain excluded 1 year, after 2 years. So if you just want to give one probability, so we do this in the red line. So if you put a 75 probability that you are excluded next year, and then from the other year to the other year, again 75%, and then 75%, that's a red line. And you see that matches like pretty closely, and it's even conservative later, like after 5 years. And this has to do with these countries that never came back. So we're not that concerned about that long run. So what we're going to do in the model, we're going to introduce this red line that we have here in this figure. The last point, I think, maybe in this audience, I have to discuss it even less, but it's clear that there are regulatory costs for banks of face value haircuts. This played a very important role, for instance, in the Latin American crisis of the 80s, where the debt were loans to banks directly, and this is very well documented. But as we discussed today, this also played a role in the recent European crisis. And so that's the third thing that we want to incorporate into this. The model, I'm going to show you the model with a few plots to see how the model looks like. So in the model, you have the following options. So we're modeling a country and we're modeling lenders. So I'm going to show you the lenders are going to price the debt in this model. And these are the things that may happen to a country. So a country maybe, if you want to call it in normal times, okay? So we start with that box with the country in normal times. And then the country has a choice of defaulting a given period or paying the debt. If the country defaults in the next period, it's gonna be what we call restructuring, and I'll show you later what that is. And if the country pays in the next period, it's gonna be again in normal times with probability 88%, and it's gonna go to a sudden stop, a period in which is excluded from market. It's gonna receive with 12%. So this is to incorporate something that doesn't have to do directly with the characteristic of the countries, have more to do with the lenders directly, that for something that happened in international credit market, the country cannot access international market. This number here comes from an estimation that we have in the paper. So now what happens when a country is in this state of exclusion, what we call in a sudden stop? Well, the country still have the option of making the payment. The difference with the previous case is that in this case it cannot borrow. Okay, so if it can make the payments and continue, but the probabilities now of continuing in this state of exclusion are a bit higher, are 42%, because these states are persistent. So when you enter this state, you're going to be there for maybe 1, 2, 3 years. So that's where the 42 probability comes from. In this case, the country can default, and it's also going to go to restructuring. So what is newer in this model is the restructuring phase. So in the restructuring phase, what we're going to have is that a bargaining protocol in which the lenders of all the country can make the offers, and when they make the offers, they are going to consider what kind of offer the other party will accept, and they will decide if they want to make the offer or not, just pass on the opportunity and wait until the next period. Okay, the offer can be accepted or rejected, and if the offer is rejected, the country continue restructuring one more period. So in this model, the time in restructuring is going to be endogenous. It's going to depend on when the offer is accepted, and when the offer is accepted, we're going to have what I showed you before in the figure is that with 75% probability in the next period after the restructuring, the country is going to be excluded, and if not, it's going to go with 25% probability. Is going to go back to normal times. Okay, so that's the model that we have, and this will play over and over forever in the model. Okay, just to say that the way we introduce the regulatory cost is as an additional cost to the market losses of face value losses, which we're going to calibrate at 3%. This number uses different statistics to arrive to the number, and we're not that clear about which number we should use, but these numbers have to do with the cost of raising equity that the bank will face if they have to acknowledge this face value or book value haircuts. Okay, so this table is just to show you a lot of statistics that you can generate with the model. Again, we think of the model as a laboratory to be able to do different exercises to understand what is happening. So in the model, all these things are determined endogenous as a part of the model, and what we want to show is in this big table in only one slide, so you can look at the statistics that you want, is that the model does generate many of the features that we observe in the data. Longer spread being higher than shorter spread being higher in bad times and in good times, also procyclical duration and maturity, also large variation of consumption in this developing economy relative to income and different facts like that. So now what we want to do is, so this step here is a step in which we are, if you want, evaluating the model to say, okay, is a model a good laboratory to proceed and do some experiments. So by looking at this table, we're going to say, well, the model seems to capture some important features, so we are going to proceed and use it to understand more things. More things about the model. The model document can get them the haircut that I showed you in the data, also the dispersion of haircuts. And what we are more important, the model can also get the mean maturity extension and also the distribution of extension. So I think this graph is very clear to show you what's happening in the data and in the model. So you have in the x-axis are the years of extension, and in the other case, in the y-axis, you have the percent of cases that are in there. And you can see that both in the model and in the data, there is like a rich dispersion in terms of maturity extension, but both maturity extension are mostly positive and around 3 or 4 years. Okay. So now let me go directly to what we are trying to use the model for, so to try to understand restructuring. As I mentioned, these are the 4 sources that I consider. So I go and get a bit into each of them. So what we do here is, like, when we solve the model and think that we have the model and we're going to run it for 1,000,000 years or many times for 100 years, to think of this as different countries, and these countries are going to default, and we are going to be able to analyze different restructuring episodes. And in this what we do in this table, we split the restructuring episode depending if there was recovery in income and no recovery in income. Okay, and the other column called all, it has all the restructuring. So you can see there that the haircut that the model gives us is around again 30 or 40%, and the extensions are also higher than 3 years. The duration of default is the time between the default and the restructuring. What is more important for the point that the recovery in income help with the maturity extension is to notice the difference between these 2 numbers here. The restructuring that have income recovery have like longer maturity extension. So if you want to take a number from here, again, we were thinking about maturity extension of about 3.5%. What we see here is by this dispersion in income, you can get up to around 1 year of difference just coming from how much income is recovered. And we do other exercises to try to argue that this is an important channel in the model, and we also document this for the data. So in the data, we also look at the maturity extensions in the case when there was more recovery, was also larger. So the second point, and I'm sorry, I'm going quickly because I know everybody want to go for lunch. So the second fact is that is the fact about exclusion. Okay. So what exclusion does, imagine you are in a country, and if you know that you are not going to be able to issue debt again for a number of periods, what you want to do is to issue long-term debt. Okay, such that the yearly payment that you have to make in the next years are relatively low. So what you see here, we calibrated this exclusion at 75%. That's the data that I show and it was shown before suggest. But then I calibrate, we show you what happened in the model if we just change this probability. Again, what we are trying to learn is what would change if that probability changes to see how important it is. And we're gonna change it. We're gonna lower up to 12%. Remember that 12% is the probability of exclusion in normal times. Okay. So what we are saying there is like, okay, what would happen with the maturity extension if the time of restructuring would look like just like normal times in terms of the probability of extension. And so you can see there that the maturity extension almost disappear. The maturity extension are slightly higher than 0. So this definitely play an important role, maybe something like 3 years in increasing the maturity extension. Okay? So I told you about the recovery in income, and I just told you about the exclusion. So let me go to the last issue. The third force. The third force that we talk is this extra cost of book value losses. And I told you we calibrated at 3%, and here I'm going to show you what happens if this value is 0. So in that case, the maturity extension is like 1 year shorter, 2.4 years. But you can imagine this number to be as high as 5%. And in some episodes, you know, we are trying to calibrate the model to see how well it can do in terms of matching this average of all these 160 episodes. For sure, there are episodes in which you may want to think of this kappa being higher even than 5%. The Latin American debt crisis, I think, is one of the episodes. And what you see is that when this increases, maturity extensions increase, so it can go almost up to 4%, just moving this percent from 3% to 5%. And the last force that I want to discuss is this dilution. So dilution, it has been discussed a lot in these theoretical models of sovereign default, and basically I think everybody knows what debt dilution does, but the effect that has on restructuring is very specific. So the idea is that when the country, so imagine a country that comes to a period with debt of 10 years of maturity and is thinking about issuing new debt. And imagine just for simplicity that this country have no incentive to issue long-term debt. There is no risk of default, no risk of sudden stop, there is no thing. So what is this country going to do? Is this country going to change the maturity from 10 years to 1 year? Well, so the answer is no. The country is not going to do that, because by doing that, what is it going to do? It's going to increase the value of the debt that has already issued. Okay, and with this, it's going to make richer the investor, but the country doesn't care about the investor. So the country is probably going to maturity 9 in the next year in that scenario. Now imagine the same country, but that has just defaulted and is restructuring, and is going to issue new debt to give back to the investor. Well, this country doesn't have this problem. The old debt is gone. I mean, it's going to be what the new countries issue. So this country, in this example, is going to issue debt exactly of maturity 1. So in this case, in this extreme case that I'm describing, the shortening of maturity would be equal to 8 years. Okay. So in our model, when we take all the other 3 forces that we discussed, well, you can see that the model indeed gives negative maturity extension. So just to summarize, what we do in these papers is document the maturity extensions. We see them very often in restructuring. Develop this model and show that these 3 forces really push for maturity extension for be longer: the recovery in income, the exclusion after restructuring, and the regulatory cost of book value haircut. Okay. Thank you.
Is this on or off? Oh, it's on. Okay. It's hearing me okay. I think maybe we lost this one. All right. Okay. So thanks for Tamon for asking me to, basically discuss this paper, and it's kind of very informative conference so far. And so I'm going to talk about what Juan just presented. And so I want to emphasize what he said at the very end, which is that, you know, in these, the models that we have, that we use to think about sovereign borrowing, sovereign default, restructuring, etc., actually has a kind of a big puzzle in terms of maturity choice, okay? And this is not just a puzzle in terms of restructurings when it is actually severe, but it is also a puzzle in like normal times as well, a little bit. So as he pointed out, you know, restructurings typically involve replacing defaulted debt with new debt that is of significantly longer maturity. We saw examples of that today. You know, there were lots of data presented that pretty much confirms that. Okay, and the goal of this paper is to see if this fact can be explained in one of these quantitative sovereign debt models. For ease of exposition, I'm going to just call it QSD because it rolls up easily from time. So this is a QSD model of the type that Juan just talked about and Tamon has worked on, etc. So at an intuitive level, you know, when we're thinking about what is it that lenders and what is it creditors would, or borrowers would want, we might think that the sovereign would be better off with longer maturity debt because it reduces the debt service. And creditors, on the other hand, because they're always worried about default and stuff, they would probably prefer short-term debt. But it turns out the logic of these models, actually everybody prefers short-term debt. And the reason for that is very simple. The person, the sovereign that is being modeled in these models is a discretionary policy maker. So if you have long-term debt and you arrive into the period with long-term debt and you decide to issue more debt, you're inevitably imposing a capital loss on existing creditors because they hold your debt and the debt is becoming less valuable. But of course, the sovereign has no interest in taking that into account, and as a result would issue debt, in a sense, kind of in an excessive way. And of course, creditors understand that, and as a result, the debt, if it's long-term, becomes expensive from the get-go, okay? And of course, now, in return, the sovereign understands this, and therefore would like to issue debt that is very short-term, because that reduces the costs of borrowing. So what you get is a model where both creditors and debtors would want short-term debt. You know, but that's not what you see in the data. Governments issue long-term debt, and in a restructuring, as he pointed out, as Juan pointed out, there is no more existing debt is all gone, so you're kind of starting afresh, and then the logic of dilution basically points you towards debt that is very short-term, and you don't see that. You see the opposite. You see the restructuring inevitably generally leads to an extension of maturity. So it's kind of a big puzzle in the context of these models, okay? That's basically, so it's an interesting thing. And so what, how can this puzzle be resolved? I think this was to the credit of the authors. You know, they thought about things that would really matter. And it turns out that it does matter, okay? Which often happens in these models is that you can write something down and put it into a model, but it turns out to make very little difference. But it turns out in this case, the three things that they focused on actually did make a difference. The first one is very nice because it comes out of the model in a very natural way, which is the cyclical dynamics of it. So maturity is shortened before default for the same reason that we have the dilution. Creditors get worried, and it becomes very expensive to borrow long term. So there's a shortening of maturities right before default. This is a well-known fact that has actually been explained in the context of these models, and Juan's model also explains it. And then after that, you know, if you have a, you know, then as you know the country recovers and the fears of default go away, then the natural tendency in these models would be for maturity to spread out. And there has to be a reason for it. You have to. I said that in the first slide that, you know, everyone wants short maturity debt, so how can you even explain long maturity debt? The way you explain it in the context of this model, perhaps I should have said that, is that you introduce a feature that makes short-term debt extremely dangerous. And that feature is the sudden stops that Juan talked about. So if you have a lot of short-term debt, and you're rolling it over every period, like 20%, 30% of your GDP, and all of a sudden you have a buyer strike and there's no one willing to lend to you, then you have to roll over that debt, which is a huge, you take a big hit on your consumption. So that makes short-term debt very, very dangerous in that way. And to avoid that danger, countries issue long-term debt. So that's the way we understand the costs and benefits of short-term versus long-term debt. So in this kind of a setup, once you have gone into default and your income is recovering, then of course you're going to get to your sweet spot in terms of maturity, and that automatically gives you maturity extension. So this is kind of a nice automatic feature of these models, which is kind of a good thing, because you don't really have to do anything. You get that in a sense for free. Okay. And then there's this fear of rollover shocks. So your income is very low when you're is below trend, and so this danger of a short-term of a rolling over is particularly high. And that's another reason why you want to issue longer-term maturity debt right in the middle of a restructure. Right? So that's a second way in which maturities get extended, the reason why maturities get extended. Because income is temporarily below trend, and rollover shock is going to be particularly debilitating in those circumstances. And the final thing that he pointed out was this lender aversion to unpaid principal. Bankers don't like to take book value losses, which was, as he pointed out, one of the biggest problems in the 1980, Latin American debt crisis. Is probably the main reason why the crisis took so long to get resolved, and it was finally resolved with a lot of bailouts. So that is a very sensible thing. We don't, as economists, we don't fully understand why this is the case. Why do, there are good regulatory reasons maybe, but then you have to ask why the regulation set up that way. But it is a fact, and the model just takes it as given, that lenders simply do not like to have a reduction in the principal payment. Rather, they would get the same present value without getting a loss on the book value, rather have the loan being paid off over a longer period of time. And so these are the three things they put into the model, and all of them turn out to be important, which is kind of a good thing, because oftentimes, we put in things that turn out to be not so important, but so it turned out that they had good intuition on all these different things. So it's a very well-executed paper, I like it a lot. There is also one thing he didn't really talk about from a point of view of solving these models, which, these models are getting more and more complicated because the computers are getting better and better, and software is getting better and better. So our capacity to solve models of this type is getting better. But still it's very challenging. And Juan has kind of borrowed stuff from a different part of the economics literature that makes the solution of these models possible. And his model is pretty complicated in terms of all the things that he's put into it. But it is a little bit it's out there in terms of what it is doing. Basically, there are lots of shocks in this model, okay? And typically we don't like to put in that much shocks into these models because, the shocks are basically unexplained stuff. But there's a lot of that in this model, but that's the way the model is essentially solved. And this is like a new way of solving very complicated models. I've personally used it myself in some of my research. I think they're kind of interesting, but it remains to be seen if the profession at large, namely our colleagues, are going to basically put up with it. But we'll see. So it's actually kind of an innovative paper in that dimension as well. Okay, so so I'm not going to really say too much about the restructuring part of things because it's already been said, a fair amount has been said about it. What I'm going to talk more about is just maturity, how do these models actually think about maturity? Maybe is there something missing in our theories about maturity choice, which may also be relevant. That's relevant in normal times and may even also be relevant during restructuring. So these comments are mostly comments about maturity choice, okay? Now what we see in the data is that we often see countries issuing debt at fairly rapid succession out of different maturities. Okay? So if you have a theory that connects the fundamentals of the model to maturity choice, you would then have to explain how is it that a country that just issued 3-year bonds a month ago now wants to issue 10-year bonds, or vice versa, because 3 and 10, these are pretty big different numbers, okay? And so that's kind of a little bit of a challenge, you know, because our models would generally say there's something about a 3-year bond or a 12-year bond or a 15-year bond that's like the right number. And unless something drastically changes between in a month period, you're not going to get a very different answer in the model in terms of what is the optimal maturity to use. You know? So if you start thinking like that, then maybe you have to start thinking about what it is that maybe it's not on the borrower side that we have to think hard about to explain these kind of changes in the maturity of debt being issued. Perhaps it is the lenders who are calling the shots. You know, one time the underwriter tells the sovereign that, you know, there is a lot of demand for 10-year bonds because there are some pension funds who are looking for long-term investment. So I can get you a good price if you issue a 10-year bond. So you say, fine, I'll do that. At other times they say, you know, there's a whole bunch of other countries that are issuing 3-year bonds, and if you issue a 3-year bond, then I can securitize this whole thing and give it to a private investor. And so then you're going to get a pretty good price. So depending upon what lenders want, and lenders don't want the same thing every day, you know, there might be, you know, these maturities move around just because lenders want different things at different points in time. Now, there is a way in which they could potentially take that into account, because I mentioned these shocks that they have in the model, but the shocks are all on the borrower's side in the model. And it's, you know, if they think about it a little bit, maybe the shocks can be moved over to the lender's side, and it might generate a different model, you know, and they might make some sense out of that as well. And maybe leverage the shocks in a way that could be novel, I think. Then this is my last slide, really. The other thing I want to say about maturity choice is that if you think about the United States, for instance, you know, the choices of maturity is basically made by the Treasury. And what is the Treasury up to? Their problem is they have a variable cash flow. There's stuff coming into their accounts, there's stuff flowing out of their accounts. There are big gaps in this. You know, all the tax revenues come in April, expenditure is being made throughout the year. So they have a cash management problem. And they're basically issuing debt to smooth out these inflows and outflows of funds into the Treasury account. And what do? And they're very attuned to what the market can absorb. So they choose maturities, they choose issuances to make sure they don't create a big, they minimize the impact on interest rates. Basically, that's kind of what they're trying to do. In contracts, you know, when you think about these sorts of cash management issues, they're simply not part of these models. The models are very focused on the borrowing side, on the sovereign, and on the levels of debt the sovereign wants to issue, but they're not so focused about this, you know, this almost like this cash management sorts of issues. Okay, so, but my sense is that I think if you're trying to really get a good grip on maturity choice by the sovereigns, including the US, you know, I think you really have to kind of think about this cash management problem carefully, and exactly how these countries, or the treasury departments of the various countries, are trying to solve the cash management problem. So in summary, I think, you know, this is a very nice paper, really. It's quite innovative in many dimensions. I mean, we didn't go through all the details of the paper, but there are at least several other really innovative parts to this paper. So I think it's a very nice paper. It will be well published for sure. And I think, you know, they are focusing on, like most of the PhD literature, on the borrowing side to explain maturity choice. But I think that's a fine place to start, but hopefully we will not stop there. I would like, you know, the authors to think more about what's going on the lending side. And a more detailed modeling of lender behavior, basically the demand side and the market mechanics as to how these sovereign debt markets, you know, how debt is placed in these markets, the underwriters, the whole apparatus of getting get from the sovereign out into the marketplace, the whole apparatus need to be examined carefully, I think, especially if you're trying to understand maturity choice. Okay, so I'll stop here. Thank you.
Thank you, Jerry. Next speaker is Aitor.
Hello everyone. Tamon, many thanks for inviting me to do this nice event. So the stuff I'm going to be presenting today is a joint work with Giancarlo Corsetti, who's in Cambridge University, Timothy, who's with Deloitte. And I forgot to add a disclaimer because these are our views and they have little or nothing to do with the use of the ESM, the stability mechanism.
Doesn't work. It didn't work. Doesn't work.
Okay. So basically this presentation is summarizing three different papers that we've been working on. And the idea here is to try to get as much learning as possible from the different policy actions that we're taking as in an attempt to resolve the debt crisis in Europe, right? And so one observation from where we move is the fact that at the beginning of the resolution of the crisis through the issuance of bailouts, the bailouts provided to the European countries, either by the euro area official lenders or by the IMF, they were designed along the lines of the International Monetary Fund. Right? So the lending conditions of these official loans were identical, either if the loans were coming, or basically identical, if the loans were coming from the euro area or they were coming from Washington. Right? What happened is that as the crisis deepened and was not being resolved, the euro area authorities, they moved away and they modified the way in which they were providing support for the alien sovereigns. The main differences were, on the one hand, the support moved beyond the traditional balance of payment support by the IMF. Best example of this is the Spanish program, which was focused only on bank crisis resolution. And then the other two aspects that are very important, and on which we are basing our analysis, the fact that the European lenders, they were willing to provide much larger loans in size, and that in addition they were willing to provide much longer maturities for the repayment, and they decided to charge spreads over the cost of funding for the official lenders significantly lower than the IMF. And this is something that we sort of like to call, when we are thinking about this approach to crisis resolution, the repayment flow management approach. The idea that you play in time with the maturity of the loans in order to provide a policy space. And the idea for this line of research is to understand what this new policy space delivers, if it delivers anything at all. I just like a few graphs that exemplify what I mean. So these two, they are showing for Ireland and for Portugal the composition of the debt creditors. And what one can see is as the crisis hit, there was an increase in the amount of debt that was coming from official creditors, especially from the European Stability Mechanism or the European Financial Stability Fund, which are the blue lines, the blue areas there. This table sort of summarizes with numbers the story that I just said regarding the evolution of the condition of the official loans. So what this table is providing is in the columns, these are time spots at which we report the different conditions of the loans, the maturities and the interest rates for either the European lenders, EFSF and ESM, or the IMF. And Ireland exemplifies very well what happened. You see the first column. The first program, the first two official loans that were provided to Ireland, they had, either by the IMF or the Euro area lenders, they had the same maturity, around 7 years. And the interest rate to be paid, if anything, was even higher from the Euro area official loans than from the IMF. But then in June 2011, then again in I think it was November 2013, there were modifications to these loans. as the situation was going out of control. And this is sort of represented on that on the table. If you look at the fourth column and you compare the conditions of the IMF and the euro area loans for Ireland, you can already see the difference there, right? So the maturity of the European loan became 22 years as opposed to the still 7 years of the IMF loan. And the interest rate chart moved from being like basically 150 basis points higher to, at that time, being almost 100 basis points cheaper, right? And there is a similar story for Portugal and the official loans for Portugal. And this translated into this presents the redemption profile of the official debt, right? And basically following these modifications to the loan. So basically the strategy that was being followed in Europe was, while originally like all these official loans in red, they were to be repaid at the same time as the IMF loan, so this was generating a repayment cliff, a pretty serious repayment cliff. The strategy in Europe was to sort of let's move this thing forward so that we generate a smoother repayment profile and see what happens. So, okay, so this is the observation. This is the big experiment that the Euro area authorities decided to do in order to try to solve the problems there. And what we have done is try to take this experiment and use it to think about, like, I mean, what this has given us, what it should have given us, I mean, what could be the potential effects. And already one goes and just looks at the existing theory about official lending, catalytic effects, debt crisis, sovereign risk. One knows that official lending is doing two things. On the one hand, it's affecting the incentive of governments to issue, to default, and it's doing that the same way that tax revenues, growth, or inflation can do. And on the other hand, it's also affecting investors' incentive, whether investors are going to be willing to roll the debt or are going to be ready to just like get the cash and move on investing in another country, is potentially affected by the actions of the official sector, right? So what we are trying to do on this research agenda is try to understand how these two sets of incentives have played out. We want to understand whether there is a trade-off, so a positive effect on the governments means a negative effect on the investors. We would like to understand the extent to which playing with the conditions of the official loans has any implications for the willingness of the governments to default or repay, or whether it has any incentives for investors to roll over in situations in which they would have fled otherwise. That's what the literature calls catalysis. And then, of course, we think that trying to answer these questions is extremely important because it has very significant policy implications, right? So with the arrival of the euro area crisis, the way that official lending proceeds, including by the IMF, has changed massively. So the IMF, for instance, they have to modify this exceptional access policy to introduce a systemic exemption that would allow to lend to countries like Greece, despite Greece was not sustainable. But because it could have systemic effects, then the policy was modified so that the IMF has effectively lent into uncertain solvency, something that it shouldn't do according to the Articles of Agreement and risk management techniques of the fund. I mean, of course, this change in approach, then it has potential implications for how the authorities want to manage spillovers, how they want to manage contagion. A contagion will potentially have important implications for monetary policy, despite this is something that I'm not going to be talking about, we are not looking at Giancarlo Luis, but we are not. And it may have important implications for the way that the authorities evaluate their sustainability and for the frameworks that are in place to evaluate their sustainability. Right? So, well, what I'm gonna do the rest of my time is present very, very briefly the outcome of the theoretical mechanisms that we obtained from a model of default with official lenders that we have built. Then I will provide a bit of empirical evidence using the data set that we have put together about whether there is any kind of catalytic effect or what is the effect of these official loans and the terms they have on the conditions at which markets access. And if I have time, I will bring back some of the potential policy implications of the results we find. Right, so the model is a quantitative model of sovereign default that follows Conesa Quijo in which we have a government that is setting taxes, is borrowing on a short-term basis from investors, and can choose every period whether it wants to repay or it wants to default. And if it defaults, suffers an output loss. The model is an interesting model that contains two types of risks for the authorities. On the one hand, there is a rollover risk. So there might be a market closure, and then like rolling over the debt becomes impossible. This provides the governments with an incentive to reduce the level of debt. But the model also has output risk. And when the government is facing this output risk, then the incentive the government has is to run up the debt and smooth consumption. Right? So what we do with this model is augment it, and we include two types of official lenders. One that is lending using short maturities, we like to call it the IMF. The other one is offering longer maturity loans. That's the one that we like to call the European official lenders. We don't add any seniority of these official loans. We don't add any moral hazard features in the model. Just to be clear what's inside and what not. Right, and once Timothy managed to solve the model in the computer, so that's what all the things that were going on. The main findings from the analysis is that in the economy without official lenders, there is a volume of debt above, and if the country is above that level and suffers a loss of market access, it's going to default. Okay, so that threshold for the debt stock in which a country defaults during a liquidity crisis increases in the presence of official lenders, and it increases more the more accommodative, that is, the longer are the maturities that the official lenders can have. Right? So this should be good news. This is telling us that theoretically the official lenders are shielding the countries from default in more occasions during liquidity crisis. But there is, like always, that you have an interesting economic problem. There is a trade-off, right? And these families of models, they do not only give us a debt threshold above which the country defaults during a liquidity crisis. They also deliver a debt threshold above which the country will default during fundamental crisis. And it turns out that in our model, having official lenders that provide these accommodative terms is reducing the debt stock above which the country decides to default under a fundamental crisis. So therefore, while on the one hand the official lenders improve their resilience against liquidity crisis, they are also making sovereigns more default prone when they are faced with fundamental crisis. Right? And in the paper, what we do is like we use all the data we have to calibrate the model to Portugal. We run a different set of counterfactuals regarding the amount of official loans received by the ESM or received by the IMF. And what we show is that depending on the conditions and the volumes of official lending, for Portugal, anything between 80 and 180% of GDP could be sustainable debt. Right? And we also, through all these counterfactors, what we are able to observe is that as regards this debt threshold for illiquidity, is the maturities that the ingredient of this official debt, or the specific term from the official debt, that seems to have a stronger effect on the sustainable access also. Right. So with these theoretical observations, then we try to go and use the data to back up something. So we have not done yet the effort of trying to understand what happens with default thresholds and against fundamental shocks, also because it's a question that we are not very sure of how we can tackle. But what we can do is trying to understand what is the effect of official loans in the possibility of losing market access by understanding what is the effect of official loans and their terms on the conditions at which the countries access sovereign bond markets. And to do this, we take advantage of the fact, this was Aitor explaining at the beginning this morning, there were a couple of occasions in which the Euro area authorities, they decided to modify the terms of the loans. This happened in June 2011 and again in 2013. Right? And then what we do is we take these policy actions as experiments, right? And then we just see the way in which sovereign bond markets behaved around these different policy actions. The first thing that I'm going to show is some very straightforward to understand and let's say simple case studies, which I'm going to be plotting the yield curves for Ireland and Portugal around some of these announcements, and I'm also going to be showing some data about the behavior of bid and ask spreads around those same contract modifications. Okay, so way to read the left and the right chart is the same. The blue line that we call pre-announcement, that's the yield curve. This is the 3-year, the 5-year, and the 10-year maturity. So that's the yield curve on the week before the announcement. Okay, you see this is a heavily inverted curve with the short part of the curve about 15%. This is a default, right? The greenish line in between, that is the same yield curve 1 month after the announcement. And the yellow curve is the same, the yellow line is the same curve 3 months after the announcement. These bars that we are plotting here, they present on the right-hand side axis the amount of change on the spread since the week before the announcement of this 7-year maturity extension. And the drop, as you can see, is very significant, it's dramatic. We are talking over 4% drop in the short interest rate. And one thing that we believe is interesting, I'm going to come back to this afterwards, is that this effect is not homogeneous across maturities. The effect is much stronger on the 3 and on the 5, which are precisely the period in which the repayment of the official loans was moved forward. So the loans didn't have to be repaid in this window and they have to be repaid forward. So that's one potential reason we believe why we observe these heterogeneous effects across the curve. So I said, one looks at bid asks, so to get a sense of how market liquidity was improving. We see a lot of improvement on Ireland, not so much for Portugal. So there's flattened out, liquidity improved, and again there is a heterogeneous effect along the yield curve. But then, I mean, this is just 3 data points. So it could be other factors, right? I mean, we decided to use the 211 because it's very clean from big monetary policy actions around. But still, we understand that this is just like 6 points. So we are currently trying to show, to bring all these same insights out from doing some econometric work. And there are 2 exercises that we have done to date. The first one is this one, and it's basically what we do here is a regression-based event analysis, in which we take the benchmark bonds, the 3 and the 5, that's the YCT, and we regress that against a set of 10 dummies, 11 dummies for each of the DA. The dummy is, the DA is a dummy for the day in which the original program was signed. DF is another dummy for the date in which the country received the first maturity extension. And DS is another dummy that collects the date in 2013 in which they received the second maturity extension. And then what we do is we regress the variables against a set of dummies that are telling us how many days before or after, within a week, we are with respect to each of the operations. Basically, we have a very large set of controls, including all types of ECB actions, stock market dynamics, VIX, oil prices. We include month-fixed effects. And the idea is that these different betas are telling us, the position of these yields with respect to anything that is away from these windows and that we like to call normal times. Right? So this is the dynamics of the Irish 3 years in a week around this is the first announcement in 2011. So as I just showed, we have this very clear downward trend on the 3. This is the 5, very similar. This is the 10, very similar but not, because look at the sizes. So this goes from 5 to about -2. This goes from 2 to -2. So this is, we go from 7 to 4 to about 2. So that effectively, again, what we are finding is that the effect is heterogeneous across the curve, right? We do the same exercise for Portugal. We get basically the same heterogeneous effect across the yield curve, even if the size of the face is not the same. Okay, just to be sure, we are just, because we were using just these benchmark bonds, separated each of them, so an additional exercise, we just go to Bloomberg, we try to find every single bond issued by these countries between 2006 and 2016. So we end up having 130 bonds. Some of these bonds were issued and mature when there was not even official loans being provided, but we think that that's a good thing because those are zeros that we want to have in our relation. And then what we do is just a very simple model in which left-hand side, we have our yields, right-hand side, we have the lag of the yield, that's a typo in this integral -1, and then we have the characteristics of these official loans in Europe, plus again the same set of control, plus our multi-fixed effects, country fixed effects. And then one thing that we do, and it's not plotted in this regression, is we allow the effect of the maturities to be maturity specific. So we interact the maturity of the official loans with the maturity of the specific underlying bonds, just to see if the heterogeneity is there. And these are the results. So basically the results you see, what we find is that there is a negative correlation between the prices and the maturities as we were postulating. But we find that that effect is stronger for short-term maturities than for longer maturities, which is again the heterogeneous effect. Second line there is showing us also that there is the positive relation between the spreads charged by the official sector and the spreads charged in the private sector. Again, evidence of catalysis. This has plenty of implications, but I don't have time to go through them, so I'm going to stop here. Thank you very much.
Thank you, Aitor. So last speaker is Tiago.
Okay, so thank you very much for this invitation. And so, as Aitor actually mentioned, this work includes a set of different papers, some more theoretical, some more empirical. So for this presentation, I will actually discuss a little bit more the empirical part of his research. That essentially analyzes these changes in programs associated with official creditors during the Euro debt crisis that implied essentially an extension of maturities and the reduction of official interest rates. So these changes were actually significant, and in the paper the authors actually describe in detail the different bailout programs and also the differences between approaches from IMF as well as European institutions. And then they actually run these event analyses where they compare like the change in government debt yields for Portugal and Ireland around these changes in the program terms. So these event analyses actually show significant numbers in terms of this reduction of government bond yields, and these were actually more important for short-term bond yields relative to long-term bond yields. They also find in the paper that there's also a significant impact on liquidity as measured by spreads between bid-asks for these bonds around the time of these programs. So some potential mechanisms are actually well known for the change in maturity associated with these bailout programs, and essentially longer maturity should reduce the current debt burden through increasing the resilience of the sovereign to repay these debts. For the case of increasing liquidity, we don't have that many models that can actually address why this is the case, but we can see that lower default probability for these sovereigns after the changing programs may actually increase demand for market funds, for market bonds of the sovereign, and therefore increasing the liquidity. So, in order to understand the main mechanisms that the authors are actually finding in the empirical part, I have here a very stylized model of government debt defaults. So essentially we can consider that a period when some amount of debt is actually restructured by this official lender, and the restructuring profile of this debt can actually be decomposed into different periods. So period 1, period 2, period 3, of course, by choosing different allocations associated with these debt repayments, there will also be different incentives for these sovereign to default across these different periods, and that should also be reflected on debt prices. That's at least given the conditions that I'm presenting here are mostly associated with probabilities of a realization of output that is below some threshold, where this threshold will change with the amount of debt repayment that is scheduled for that particular period. So essentially the implications of this very simple model says that reducing debt repayments today by deferring these repayments to the future actually improves that sustainability for the present day, but at the cost of decreasing this sustainability in the future. And similar actually happens for the yield of bonds. So essentially backloading these debt repayments into the future should decrease these government yields for short-term debt, but at the same time increase the yields for long-term debt. So essentially, if you have an inverted yield curve, this should imply a flattening of this curve, and this is also consistent with the findings of the paper. So, some comments regarding these event analysis results that were presented in the paper. So, for the first one, the authors actually compared the yield curve for different maturities, 3, 5, and 10 years before and after these program changes. And the program change actually extended maturity for 15 years, so it might be actually hard to find this negative effect on government yields, given that the profile of repayment actually was below the 10 years, so it would be interesting to extend this event analysis to include longer terms of these yield curve. The paper also finds that official lending reduction of these interest rates implied very large savings on the overall debt burden for these countries. So when we actually take into account the different type of, or the two type of program implications when this debt was restructured and conditions actually changed, we may actually have a confounding effect between this change in maturities versus a reduction in official lending interest rates. So the authors also present some, regarding the previous point, we could actually try to use the 2013 program change in conditions that mostly changed the maturity to try to separate between these two effects. So the authors also find some evidence suggesting that the private sector lending improved around these program changes for lending to the sovereign. And essentially they look at these credit market for securities in these firms, so they actually find that yields for these corporate securities reduce. But of course, in most countries in Europe, markets for corporate bonds is relatively limited, so it would be also interesting to see if this result also extends for other forms of credits. And finally, we can also think about what are actually the lessons that we learn from these changes in terms associated with official lending during the crisis. associated with the 2012 Greek debt restructuring program. So we may want to think about incomplete bank bailouts and a potential contagion that may have actually happen in Cyprus. So regarding this point, we actually know that in 2012 the Greek debt was deemed unsustainable, and this actually led to a default on private owners of government debt for Greece. So this private sector involvement actually wiped out some large amount of bank capital that actually triggered a bailout, and this bailout was also used to recapitalize banks associated with these default events. Whether this recapitalization was enough may be an open question, but in 2015 there was another bank run in Greece that led to some further bank recapitalizations. So at the same time, this type of private sector involvement debt restructuring programs may lead crises for other countries where there's no bailout linked to the program of the banks. This may be what actually happened in Greece. So also thinking about these potential incomplete bank recapitalizations, we may say that excess leverage may actually increase input misallocation due to the fact that now banks are not operating as efficiently as before. So this may actually affect investment and input allocation for different production units in an economy. This may actually reduce contemporaneous output, and simultaneously, if this type of crisis actually prolongs in time, may even affect market access by lower debt prices of government bonds, whether these bonds are at the short end of the maturity structure or at the long end. So essentially, this type of incomplete bank recapitalizations may undermine the sustainability of these loan programs, and actually there is some recent and not so recent empirical work that actually points that indeed there is a bank, an important bank channel on explaining dynamics associated with investment and recoveries after a big recession, and a recession that actually implies a default situation. So just to conclude my presentation, I'm just plotting here three different crises for Portugal, Spain and Greece. So the two first panels are very well known. So this is the drop in GDP for and investment for these three countries. We observe a very strong recession for Greece and more mild recessions for Portugal and Spain. At the same time, for the last panel, I'm actually showing these financial liabilities for private entities in these three different countries. We observe that credit flows into Greece seem to be much slower than in the other two countries. And of course, we may want to think whether these prolonged recovery for the Greek crisis is actually related with this slowdown of credit disbursement in Greece as compared to Portugal and Spain. So of course this is an open question, but an open question that we can now think, given that we have papers like the one that Aitor presented in here, that analyzes these different programs and different conditions associated with the program. So thank you.
Thank you, Tiago. Let's just let the floor speak. Any questions? Probably one or two questions quickly.
Thanks very much. Steve O'Connell, Sportsman College. So this is a question for, I guess, Dr. Chatterjee or Juan Sanchez. Thanks very much. On the puzzle of why countries, borrowers might like lower maturities, I agree just wholeheartedly. This is a great paper to give us a reason for understanding the advice coming from all quarters to countries to avoid short-term debts. So putting the rollover risk into the model in the various ways you did and getting some leverage from that seems to be a great thing. But I guess I have quite a specific question about maturities, and especially for, the question is there a distinct reason for countries to prefer longer maturities that is matched somehow to the structure of the assets that they're trying to acquire? So I'm thinking particularly of low-income countries who are now entering bond markets for very specific reasons, big infrastructure essentially, and are having to borrow pretty short for it. Could you comment, either of you guys, on whether there's an optimal maturity of debts of that type, or an optimal, and if there is, should these countries preemptively be moving to lengthen the maturities, for example, as their overall debt issues become a little more nervous?
It's a right point. You know, like in corporate finance, this is kind of one of the issues. So I have actually worked, and there is other work in which you look at why firms want to borrow long, and there is like matching the maturity of the asset and maturity of the debt. In sovereign default, I haven't seen papers looking at that, but it seems reasonable. You know, if our models just don't have, let's say, the size, actually most investment that the country can do in this model is nothing, and in some other models it's very simple, so it doesn't have a maturity for investment. But if we will include, I would expect something like that, because in corporate finance, that's one of the factors.
There are countries, I don't know, maybe Turkey is an example, where large infrastructure projects are basically run through the government, but it's basically funded by tolls, etc., that are earmarked for, all the revenues earmarked for a particular investment vehicle. So in that case, there is a matching of the project that is being funded and the money that is coming in, but the government is still in part of it, and there is still an issue, I guess, of sovereign risk in that context. I don't take my word for it, but I think maybe that's how some of the bridges or some of the roads and infrastructure in Turkey has actually been funded. And in fact, the funding was also in foreign currency. So during the crisis, this became a big issue because they were paying out in euros or dollars at the exchange rate had moved extremely adverse. But in general, I don't know, maybe these sorts of sovereign debts that we were talking about are like borrowing on very general accounts, I guess, of the government, the general obligation bonds, as we would call them in the US. But if you talk to people at the World Bank, for instance, I'm sure there are funds being dispersed for very specific projects. So there is like a whole range of funds that flow into these countries, and the things that we're talking about here are kind of a small subset of all of that. These are basically bonds that essentially end up in the savings accounts, and that's just a small part of the total amount of funds these countries are getting from outside.
Okay, many thanks to the speakers, and also thanks to the audience to stay a little bit longer and patience for waiting for the late lunch. Just close the session now.
Okay, thank you very much. Thank you, Tamon. Thank you all the speakers for a very interesting presentation. Now, if I can conclude with summarizing just one thing that I would like to say, not as an IMF person, but also here for the whole session today. Now, the debt issues and the debt restructuring, we should not forget that it is a debt sustainability analysis issue. And with that, I would like to conclude and thank you all, for both the presenters and also all the attendees, for coming today and having, I think, a very successful and interesting conference. Thank you all.